Coming up on Market to Market, Harvey heaves record-breaking rain on Houston and beyond, and the pricing challenges of a key ingredient in a growing market. Those stories and market analysis with Sue Martin.
But
next.
Beside all of that, you've got the Middle East.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, September 1 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Hurricane Harvey has come and gone, but is far from forgotten. The 1,000-year flood is roughly the size of New Jersey. And Harvey left fingerprints all over the world as Houston, the second largest port in the U.S., was shuttered, keeping goods at sea or in port. The monthly unemployment report issued Friday doesn't include any impact from Harvey. The rate did tick up to 4.4% as 156,000 jobs were added in August. However, consumers are feeling good about today's economy, giving it the highest confidence grade in more than 16 years. Drivers for this holiday weekend will notice the hurricane's influence at the gas pump. Nationally, AAA reports an average of $2.45 per gallon, the highest of 2017. Crude oil is headed in the other direction. The October contract experienced its steepest loss in more than a year on slower demand with Texas refineries offline. The biggest rainstorm in U.S. mainland history fell in feet and didn't stop for days. The damage assessment is ongoing. Dave Miller reports.
Hurricane Harvey stormed ashore and washed through the nation's fourth largest city, dropping a record 52 inches of rain in a short span of days. The deluge made for widespread flooding, which was followed by hundreds of rescue operations carried out by a combination of military, law enforcement, and neighborhood friends.
I told my wife I have to go help.
We're now also dealing with catastrophic conditions in southeast Texas, and those conditions are a threat to life and property.
The Category 4 hurricane has taken more than 35 lives, and many more are reported as missing. Damage estimates to property alone have rolled over $180 million, as 100,000 homes have been reported as damaged. President Trump visited midweek as the devastating hurricane turned into a tropical depression.
And I just want to say that working with the governor and his entire team has been an honor for us.
Vice President Pence surveyed damage as the week came to an end.
The American people in the world have been transfixed with the images of destruction and suffering, and the resilience of the people of Texas and Louisiana as Hurricane Harvey has battered that state.
This refinery in Port Arthur, Texas, was submerged under floodwaters. 1/4 of the country's gasoline refining capacity, about 4.4 million barrels a day, was taken offline by the storm. The U.S. government had to tap oil reserves for the first time in 5 years. Infrastructure repairs could take months. Farmers and ranchers moved cattle to higher ground before the storm began and later assessed damage as the storm blew through on its way to points northeast. Texas leads the nation in cattle and cotton production with 1 of every 7 jobs related to agriculture. Lone Star State agriculture officials say hundreds of cotton modules were blown apart by gale force winds, and many more were lying in wet fields and gin yards. Rice producers had already harvested 75% of the Texas crop, and the U.S. Rice Producers Association says the rest of the crop was destroyed. There is no official word on the number of cattle killed by the storm and its aftermath. The president had already laid the groundwork for relief by issuing a disaster declaration just as Harvey made landfall late last week. USDA officials were spreading the word to farmers and ranchers about eligibility for disaster recovery programs focused on losses to cattle or crops. The U.S. House is expected to act quickly to provide relief for those affected by the storm. Rain is expected to fall for a few more days across parts of the South as the tropical depression weakens. For Market to Market, I'm David Miller.
The kickoff to college football season brings tailgaters out of hibernation. As the revelers dust off their coolers, they fill them with ice and, most likely, beer. The adult beverage consists of 4 primary ingredients: grain, yeast, water, and hops. The latter has become the center of a price discovery premium. Peter Tubbs has our cover story.
60 acres of trellised vines in Yakima County, Washington, are home to a key component of America's burgeoning craft beer business. The hops grown here add the bitter flavor in beer, that snap on the palate, which comes from the variety and volume of a primary ingredient used in the brewing process. For craft brewers like Nick Bowes of Rock Island, Illinois, the decision on how much of the indispensable spice to use in Bent River Brewing's newest offerings is a delicate balance.
So we have a fairly knowledgeable market, around here, and they want the breweries to, what's new, what's next. They want to see, every time they come in, they like to see a different beer that they can try.
For brewers, the customer-driven pursuit of hop flavor creates a price conundrum, finding the right hops at a profitable price. However, brewmasters often purchase the vital ingredient blind because the market lacks transparency. Part of the problem is the size of the market. While the industry generates $2 billion in sales each year, less than 100 growers produce the majority of American hops. With over 100 varieties in use, there are essentially 100 separate markets, each susceptible to price swings due to demand, weather, rumor, and fashion. Douglas McKinnon has worked in the hops industry since 2000.
We know roughly where the prices have been, and we know roughly what the market will bear. And so then you somehow in the middle there have to calculate your profit and then try to negotiate a good deal with the growers.
To avoid being caught in a scarce price environment, both brewers and merchants contract hop sales, often 3 to 5 years into the future. Farmers benefit by removing some of the variability in their incomes. Merchants have a destination for the hops they buy during harvest, and brewers get predictability in their production pricing.
We usually end up about third quarter every year trying to sell off some of our excess from our contract because, again, I'd rather be slightly over-contracted than just be not unable to produce one of our core products.
The journey of hops from hop yard to beer glass has multiple steps. The hops must be separated from the vine, then sent to a kiln for 8 hours to be brought below 10% moisture. Then packaged in 200-pound bales for storage at 34 degrees until they can be either compressed into pellets or converted to an extract. Hop pellets, if properly stored, have a shelf life of up to 3 years. Canned extract is good for a decade or more. The multi-year shelf life of hops can actually make a spike-prone market more volatile. With no standardized inventory data, a bountiful harvest in one production year can depress the market for several years to come. Higher demand from the craft beer industry has boosted United States hop production 28% since 2000. As an affordable luxury, a young generation of beer drinkers has adopted craft beer over the mass market beer their fathers drank. This market shift has encouraged the installation of thousands of acres of hops in the Pacific Northwest, worrying some that a crash in hop prices may be on the horizon.
So what happens is the hop industry is never in balance. It never finds equilibrium. So it's always either oversupplied or undersupplied.
Craft brewing uses dramatically more hops than conventional brewing, and craft beer continues to carve market share away from national beer brands each year. Hop production is expanding to meet demand, with 8,300 acres added in 2016, the third consecutive year of double-digit percentage growth. The Gamache family has been farming hops in the Yakima Valley for 75 years.
So hopefully, by the time that you're harvesting your crop, you already know what you're going to get for it and where you're going to deliver it.
The arid Yakima Valley is an ideal growing region for hops, and the climate allows farmers to reconfigure their yards to meet changes in demand year to year. But the opacity of the hop market makes those moves risky without long forward contracts with merchants and breweries. The capital requirements of hops are immense. 10 acres of new hops can cost $500,000 to install and grow the first year, but can gross $12,000 per acre annually. And any plans to process hops require a minimum $2 million capital investment up front. This includes the separator and kiln required to prepare the hops for storage and eventual processing into a format brewers can use. High startup costs acting as a barrier to entry for prospective growers, coupled with the volatility of the hop market, has led to legacy operations with many on their third and fourth generation in the valley. The institutional knowledge is important to weather the lean years when hop prices collapse.
Guys that I'm drinking beers with, one day my grandfather probably drank beers with their grandfather. And
most operations are diversified across crops and calendar. Crews will pick hops, grapes, or apples, depending on what is ready that day.
I think we're going more in the direction of the English-style pub, where local is really important. But there's tons of room at the bottom of the scale, where you have a guy who's a brewer in their neighborhood and they have 5,000-10,000 loyal customers. There's tons of room for that. And if that's the trend in the market, we could easily have 10 or 15,000 breweries in this country in the next few years.
From Market to Market, I'm Peter Tubbs.
Next, the Market to Market report.
The new commodity market trading year was rung in with rallies following expiring sell-offs as many producers emptied their bins. For the week, the September wheat contract improved 4 cents and the nearby corn contract moved 2 cents higher. Continued foreign demand helped the soybean complex attain a nickel gain. December meal lost $1.20 per ton. Harvey put a damper on cotton harvest but helped rally the market as the December contract jumped $3.73. Over in the dairy parlor, September Class 3 milk futures declined 50 cents. Livestock was mixed again this week as the October cattle contract shed $1.78 and nearby feeders went 60 cents higher. The October lean hog contract weakened $1.63. In the currency markets, the U.S. dollar index expanded 9 basis points. Crude oil lost 58 cents per barrel. COMEX gold increased $32.50 per ounce, and the Goldman Sachs Commodity Index improved just over 7 points to finish the week at 386.15. Here now to lend us her insight on these and other trends is one of our regular market analysts, Sue Martin. Sue, welcome back.
Thank you, Mike.
We're glad to have you. And in case you want to go over things again, you can download or listen to our Market Analysis and Market Plus podcast anytime online at iptv.org/MTOM. Sue, I want to kick this off by looking at the wheat market. We finished this week, the 31st and the 1st, with a 13-cent rally, 12-cent rally in front month Chicago wheat. What kicked that off?
Well, I think part of it is the market is just so cheap. And, you look around the world and there's more issues in Australia, more lowering of their crop. You had Stats Canada coming out with less production than a year ago, and they were down sharply a year ago. So I think that the market is just to the point where it was just getting so oversold and so demoralized that, and then you get contracts that are coming due at the elevators, what have you, sort of similar to corn. I think it was just a combination of various things, and the market got a short covering rally. We're into a new month, so it'll be interesting to see, can we take this market and continue to push it? In the meantime, I think there was continued unwinding of spreads between Minneapolis and the KC and Chicago. The Minneapolis, there is some talk of much better yields than what some were thinking in the eastern side of the state and on into the northwestern side of Minnesota. Yields anywhere from 80 to 100 bushel per acre. Phenomenal yields, not so great in protein.
Okay, so there's still going to be a premium for protein this year.
Yes.
It's just we might have more spring wheat than we'd initially thought when the summer was going on.
But then they still got to get further west, and they're going to find that it just isn't. So it'll kind of, for the state, average out a little bit. But for right now, I think that was a rather big surprise. And then on top of it, that puts hedge pressure into the market. So the Minneapolis fell about 20 cents from a wave 3 count on the downside at 620. And then, of course, the offsetting of shorts against it on the other two contracts as they try to narrow that spread.
Now, from the Commitment of Traders report, how are the spec funds sitting in the wheat market? Are they still fairly short?
Yes, they are.
Okay.
Yeah, they are. They're fairly heavy short, and but that could be a nice positive for this market when it finally gets that enthusiasm to start making a turn.
Do you think it'll be a long-term turn when it turns?
When it turns, I think it will be. Okay. But because we've already hit wave 4s on the downside in wheat, we even extended them a little bit. So I think the market can do that. Now, that's the KC and the Chicago, not the same situation, of course, in Minneapolis.
Well, now let's take a look at the corn market. We've got a question here from Roger in Ionia, Missouri. And, of course, we talk a lot about the end of the delayed pricing comes up on August 31st. Yeah. Roger wants to know how much old crop corn is still in bins after we come through the end of a week and see a rally like we saw Thursday and Friday.
Well, for one thing, I wondered just how well the elevators followed the rally. You know, there was a fair amount of corn yet still to come. Farmers had hung on a little too long, very similar to a year ago. The personality, or not the personality, but the perception in the marketplace, the psychology was extremely demoralized as we came into Thursday. And so when the market hit that and we're on first notice day, all of a sudden we did a nice short covering rally. We did a key reversal is actually what we've done. And so we'll see how well that holds in the marketplace. It's awfully ironic to have hit the exact same day for a low as we had a year ago. A year ago, we had cycle window timing on the 31st to the 1st of September for a low, and we got it. It was also a derivative in corn of an 84-year cycle.
Okay.
Well, we got that. But corn put a low in of 301 on the September contract, lead contract, and the D's got down to 314 3/4. So we're still nicely higher than that. So things aren't really quite as bad as they were a year ago. It just feels like it because producers made the same mistake again. So, you know, I suspect after 2 years of this, next year's going to be a whole different ballgame. They aren't going to be hanging on like that.
Yes. Now, as we look ahead, harvest is getting closer and closer. Of course, it's kicked off in the south, the corn harvest. It's going to be moving north as we go through the month of September. Producers who are planning on storing grain, but they know that they could have some excess bushels, how do we handle them? Is it going to be worth putting them in storage commercially as we get into harvest?
Well, if they do, what they might want to do is buy some puts and floor it. Because when you look at and do it out in the deferreds, because you've got carrying charge markets here. And so this is one situation where it's an old-fashioned market where you go to sell grain or move grain, and then you want to re-own it. Well, all of a sudden you're looking, if you're trying to get time, you're looking at a contract that's quite a bit higher than where you are today. And then you run that risk as one expires, the next one just sort of sinks down. So I would say maybe this is a time where you do go and buy puts. That way, if you've got the crop you're going to put into the elevator in storage, you know, you've got it floored to protect yourself and leave your top side open. Because the market is extremely cheap. In fact, December corn hit a wave 5 or within 4 cents of it. And I've only seen one commodity ever do a wave 5, and it was cattle in 2015 in December. Well, corn got close to it. I went back to the drawing board and thought, okay, let's play a mind game here. Let's see if there's anything else out there. And I could, with this year's December contract, from the very first day it came on the board back in 2014, I could come up with a wave 5 projection at 327 1/4, which isn't still super far away. What it tells me is the market's too cheap and it's going to try to find a level here to bottom. We had a beautiful day, just shorts were running for the door for the first time. But, you know, there's a little seasonality here. You know, like in beans, markets tend to rally into September 8th, 9th, 10th. You've got a full moon coming up next week, and there's talk of potential frost freezes.
Yes.
And so the combination of all that, and then you look at FC Stone's numbers and what they came out at, and boy, you're looking at some really reduced production, corn denting down sharply from a year ago in the 3I states. That's a concern, and so, you know, it's not over till it's over, and it's not in the bin yet.
Well,
so
that's
we've got
true.
to watch it.
And Sue, you mentioned the frost scare that has been in the forecast off and on for the past couple weeks. As you look at the soybean market, we saw a nice rally again tail end of this week.
Yes.
How much is that frost is being traded right now? Do we need a more concrete forecast?
Well, if you look at the market, it's kind of like, I think all markets feel this way, a little funky and lackluster and disbelieving, so to speak. If you recall, when the wheat market, when the hard red winter wheat got that 21 inches of snow on it, the market didn't respond. We went into, after planting, and it was just up, getting freezes last fall. The market didn't respond. So it's kind of in that mode.
Okay.
But again, in beans, we have that derivative of the 84-year cycle that I've talked about forever, I think. It's our last opportunity, was in August, and 921 was our second support for the month, and we got that right to the net.
Okay.
But just visualize beans in June hitting a wave 4, rallied $1.40, and then turned around and came back to 921 with the previous June low at 907. I gotta say, I'd like to say the 84-year low is in, but boy, there's something about this I'm not trusting real well.
Okay.
I've got to see better confirmation that I'm seeing. One of it would be, we did take out a cycle window high of 950.5. That was good, but cattle have done similar things too and then failed. I'd like to see beans eventually get up and take that 988.5 out, the high of the government report in August when they threw the kitchen sink at us.
Okay. Now, Sue, we've got to talk about the cotton market very briefly. Hurricane Harvey, of course, driving that market. A lot of acres worth of cotton destroyed. Put on $3, almost $4 this week in cotton. Is there still room to move higher?
Well, you've got the aftermath over, but the damage has kind of been done.
Yeah.
So I think the market tries to come in this week a little higher, but we'll see if it's able to follow through. The pattern has been maybe not. We might rally cotton into, like, say, Wednesday, maybe Thursday, and that might be the best it can do. I would probably, if you were blessed in a different area, you might want to look at some pricing.
Okay, could be a selling opportunity. Now let's look at the livestock markets. We see live cattle continue week after week to slog lower. Sue, are we getting close to finding a bottom here in cattle, or are we going to go all the way back to that 96 and change we traded earlier this summer?
Well, first off, we have to remember we did not, even in our rally in April contract made higher highs, but for a lead contract, we did not take out the highs of last year. So therefore, we're still within that range of a year ago. You know, the lows are fair game. However, when I went back and I looked at the study that I started with for this year's thought process, February cattle went off the board strong. There's 23 years since 1970 that we've done that. Out of those 23 years, every one of them went on to see the April contract move on and be strong and expire good too. Then the June was kind of, it could maybe move around, but it didn't normally make a higher high for the lead contract. What was interesting was, out of those 23 years, 14 of them put a low in August or the very early days of September. We have timing on cattle on September 5th.
Okay.
If we can hold cattle near these lows into September 5th, we might start to get that turn and move out of here. Now, the 9 years that went down into October, I thought it was interesting because every one of those 9 years had the August rallying to a better level than July.
Okay.
Did not happen that way this year. So never say never in this business, but I think cattle are going to put a low in here early this next week, and I think we're going to turn, and if I'm right, the eventual progress should be higher all the way into the turn of the year. because we've got less cattle coming as we roll the year over. And I think demand's excellent. Our exports have been phenomenal. Some say, oh, we're going to fall back now in September. Maybe. But here's the other thing. Nobody thinks about Houston and the surrounding areas and all the meat that was lost in that area, contaminate, whatever, the schools, the grocery stores, the homes, restaurants, everything's going to have to be thrown and reordered. Kind of like something we've seen out in, I think it was New Jersey and that area.
After Sandy.
Yes.
You bet.
And so I think that's going to set up another demand. Might take a little bit, but I think it's going to add to the demand. And then in the meantime, yes, cattle are starting to gain. But the thing is, we have packers with an enhanced killing capacity. And yes, there's talk that they've got good numbers already pre-bought, but you know, the weights are inching up seasonally. But I guess I have a hard time being a bear, and my weekly data is like extremely low. I'm just waiting for the confirmation of a turn.
All right, and once we turn the live cattle market, you think we'll also find a bottom in feeders?
Absolutely.
And that'll pull it right along higher.
Absolutely, because your pastures are in better shape now than they were. So that'll allow to be able to put some feeders out on grass, and then, you know, we'll see how much wheat pasture we come up with this year. But things are looking a little better. Then the next thing is on feeders. If I'm right on fats, I don't see feeders going down.
Okay, right. They're going to follow right along. They'll see that margin and they'll chase it.
Yep.
And Sue, we will be back in the Market Plus segment online. You can find that at Market to Market to discuss your take on the lean hog market.
Okay.
So thanks so much for taking the time to join us, Sue. Always appreciate your insight.
Thank you, Mike.
That wraps up the broadcast portion of Market to Market. However, as I mentioned, Sue and I will keep the conversation going, including answering more of your questions during the Market Plus segment, which is available in podcast and video form on our website. While you're there, check out the link to our Facebook page. You can find it at IPTV Market. It's right there. That's where you can send us questions, and you can consider it our digital connection to you for stories, pictures, and videos. Join us again next week when we'll explore the battle for GMO oversight in Oregon. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.